You've seen the headlines, right? They're everywhere. Some tech unicorn or a massive global brand is finally going public. The excitement is just electric, the numbers are absolutely staggering, and who can forget the buzz when companies like Facebook or Tesla hit the open market? But what really happens after all the confetti settles? So think about it. When a company that's worth tens or even hundreds of billions of dollars just suddenly appears on the stock market, what does that actually do to the entire system? We're talking about big indexes like the S&P 500. Does it create this massive tidal wave that just upends everything? Or is it more like a tiny ripple in a really, really big ocean? Well, that's exactly the question we're digging into today. All right, so the first major effect kicks in immediately, like on day one of the IPO. And it's all about the money shuffle. Where does all the cash to buy this hot new stock actually come from?
So the key idea here has a couple of names: liquidity drain or portfolio rotation. The logic is actually super simple. The money to buy billions of dollars of a new company's stock has to come from somewhere, right? Most investors don't just have that much cash lying around. So what do? They have to sell some of the stocks they already own to free up the cash.
This whole thing plays out in a pretty predictable four-step shuffle. First, the mega IPO launches. Boom, a huge new supply of stock hits the market. Second, investors want in, but they need cash. That leads to step 3. They start selling their existing stocks. A lot of times it's stocks in similar sectors or maybe just some of their biggest holdings. And the final result of all that selling, it puts this temporary downward pressure on the broader market, causing a little dip. It's almost like the market is a big pool of money and the shiny new attraction is making everybody run over to one side for a minute. So the bottom line here is that this money shuffle creates a very real, measurable effect. You get a short-term spike in overall market volatility. Things get a little choppy for a few days, while all that capital gets reshuffled from the old stocks to the new one.
But, the story doesn't just stop on IPO day. Not at all. The next big event for a successful new company is getting added to one of the major leagues, an index like the prestigious S&P 500.
And this whole process, it's really like a two-act drama. There are two very distinct, very important dates, and each one has its own unique impact on the market. Okay, so Act 1 is what we call the announcement effect. This is when the S&P committee announces that the stock will be added at some point in the future. The stock itself, it usually pops on this news, but the index as a whole barely even budges. Then you have Act 2, the inclusion effect. That's the day it actually happens. This is where you see the real market machinery grind into gear. All the index funds are literally forced to buy the new stock, which leads to this massive one-day surge in trading volume and a burst of volatility for the index. And just how big is that pop on announcement day? Well, get this. Historical data shows that on average, a stock jumped about 8.8% just on the news that it was going to be included. That just shows you the incredible power of all that anticipated demand from the index funds.
Now, to really see this whole thing in action, there is no better case study than one of the largest and, let's be honest, most volatile companies ever to join the index, Tesla. I mean, the scale here is just mind-boggling. On the day of inclusion, index funds had to buy over $80 billion worth of Tesla stock, all at once, all on one day, just to rebalance their portfolios correctly. It was an absolutely monumental trade.
So you'd think, okay, adding a notoriously volatile stock like Tesla must have made the whole index way riskier, right? Well, surprisingly, not really. Check this out. This chart shows that if Tesla had been in the S&P 500 for all of 2020, the index's volatility would have been 27.35%. Without it, it was 26.98%. Yeah, it's a difference, but it's an incredibly small one. The index is just that diversified. And here's the craziest part. Because all those index funds were forced to buy Tesla at its peak price, after the announcement hype had already driven it way up, it actually created what's called a performance drag. One analysis found that the S&P 500 performed about 0.41% worse over the next 6 months than it would have if it had just stuck with the old stock it replaced. Basically, they were all forced to buy a high, and then the stock price kind of settled down afterward. Okay, so let's put all this evidence together and finally answer our opening question. How big are the waves from these giant market newcomers?
So let's just lay it all out. On the IPO debut day, that big money shuffle causes a short-term spike in volatility and a little bit of temporary negative pressure on returns. Then, later on index inclusion day, that forced buying creates a huge burst of trading volume, which can lead to a modest, short-lived drag on performance. You see the pattern here? The key words in both cases are short-term and temporary.
And that brings us to the key conclusion from all the research, and it is this: these effects are transient. They're temporary. Huge IPOs and index inclusions, they cause some short-term turbulence for sure, but they do not fundamentally change or derail the long-term path of the market.
Okay, so what does this all mean for you? As an investor, or even just as an observer? What's the big takeaway from all this? How do you navigate the hype?
Let's break it down. If you're a long-term index fund investor, the message is really simple. Just relax. These events are basically just noise in the grand scheme of things. Your long-term strategy is totally unaffected. Now, if you're an active trader, this noise is the signal. These predictable moments of volatility are exactly the kind of short-term opportunities you're looking for. And for everyone, I think it's just a powerful reminder of how incredibly deep and resilient our financial markets really are, capable of absorbing even the biggest new companies without really missing a beat.
So the market has proven time and again that it can handle today's giants, but it does leave us with one final, pretty fascinating question to think about. As companies get bigger and bigger, is there some theoretical IPO out there, one so massive that it could finally be more than just a ripple? Could it be the tidal wave that truly tests the absolute limits of our market system?